Welcome to the Professional Investment Podcast. I'm Charlotte Moore, award-winning journalist and co-founder of Moore Squared Communications. Each episode, we welcome a guest to the show to share their news story of the week. And I'm delighted to welcome Claire Altman, Managing Director of Pension Risk Transfer and Individual Retirement at Standard Life. Welcome to the show, Claire.
Hi, Charlotte. Delighted to be here, and thank you for asking me.
Delighted to have you on the show, Claire. Do tell us, what is your news story of the week?
So my news story is most defined benefit members are open to run-on, and this was a survey run by Hymans Robertson.
And do tell us, why have you chosen this as your news story of the week?
Right. Well, so it's a super interesting story, and I think chimes with a lot of the way that news is being handled at the moment. So the question is, the big question is that when people make judgments, are they making judgments with the right information? So if you think back to the last few years of UK history, there's been obviously certain changes that we don't need to get into here, but the big question is, would people have made the decisions they would have made if they had all the information in front of them? So that's really the gist of what I wanted to talk about, which was this headline, which is DB members are open to run on. Is that DB members open to run on with all the information they need, or is that DB members open to run on with a more limited subset of information? So that's why this story interests me. It's that it's kind of pointing to some of the challenges we have of our age, just with information management and kind of getting the truth out there to people, and yet. So we are we seeing that in a kind of defined way in the DB world just at the moment?
Yeah, and I mean it's an age-old question as well, isn't it? If we think about you kind of alluded to politics and political polling questions. You can get people to give the answer you want if you frame the question the right way. So
That's
there's sort
exactly
of two things going on. It's about how you frame the question, and if you're providing enough information as well when you ask the question.
Exactly that, and how to give the information truthfully, because these things are complex, and we all know we're in an information age where people's attention span is relatively short. Are they interested enough to engage, to learn, and so on? And that's obviously half the challenge as well. But I think the key thing is that before anyone makes judgments on the back of a headline like this, to understand the limitations of understanding and so on of the people who are saying that they are open to run on.
So, well, we've got half an hour to deep dive into that. So everybody who's bothered to listen to this, we can talk about it more. So let's start with that question first. What are the real trade-offs between buyout and run-on from a scheme member's perspective?
So I think it's a very, very interesting question. And the challenge for those people who are making decisions, which is really the trustees, but obviously the corporate is sitting there as well, is are you comparing apples with apples? So if you think of a pension scheme, you've got liabilities, you've got to pay out benefits over a period, and you've got assets which are backing those liabilities. And in order to know that you can pay benefits over the long term, you need to have a certain amount of confidence that the assets that you've got will be enough to pay out those benefits. So you've got the two sides, and you're trying to balance the numbers. Broadly speaking, you need to know that you've got enough on the asset side to meet the liabilities, right? The real trick then comes in the way that those numbers are calculated, because at the end of the day, you don't know if you've got enough money, right? You don't know. You don't know how long people are going to live, so you don't know how long you're going to have to be paying out the pensions for. So there are underlying these kinds of decisions are a lot of assumptions. And the question is, when you are making those calculations, how are you going about thinking about risk? And what we know is that insurance companies, because of the way that we're regulated, we have very onerous requirements in terms of the way that we have to think about the risk of things not happening. And the widely quoted number is that we have a kind of 1 in 200 event underlying calculation, that we have to be sure that we have enough money to cover unlikely events, even if they're a 1 in 200 scenario. So hopefully that kind of makes some kind of sense. But when trustees generally are thinking about whether they've got enough money to pay out these benefits, as I say, it's not known for certain what those benefits will be, because you don't necessarily know how long people are going to live. Are they thinking about risk in that 1 in 200 event way? And most of the time, we think the likelihood is that they aren't. They aren't thinking about risk in the same way that insurance companies are, because they're not required to, and that's not their experience, and that's not the way generally pension schemes are run. So when you say well, you've got 100% chance, for example, of paying out benefits if you buy out, compared to, say, a 98% chance of paying out benefits if you run on, those two numbers are calculated in a very different way.
Yes, there's a regulatory arbitrage, isn't there, between the pension scheme and insurance company, because they face such different regulatory frameworks.
Exactly that.
And so who really has greater flexibility? Because you would imagine if a pension scheme is more likely regulated than an insurance company, that would give it greater flexibility to invest. But you'd think that, right? But it doesn't really seem that way, does it? Always.
No, but I think the focus. I know that we're an investment podcast, so I'm going to take a bit of license. But interestingly, the focus is almost less on the how can you invest, and more actually on, are you clear about the risks that you are risks that you are running? Yes, that's right. And do you want to be running those risks, and are you being rewarded for running those risks?
So you've teed that up perfectly, Claire, for the next question. So let's take a deeper dive into those risks. What are the key risks that you're running as a pension scheme that people should really be aware of?
So there are three basic risks that you're running as a trustee. As I say, you're running the risk that your assets are enough. That's risk number one. The second is that, because defined benefit schemes, they're also known as balance of cost. Why are they known as balance of cost? Because to any extent the assets are not enough, there's an ongoing responsibility for an employer to top up the assets. So you are effectively then investing in the employer, and that's called covenant risk. And then the third risk you're running is on the liability side. What are those liabilities? Do you have sufficient knowledge of them? Can they increase in size, and so on? So those really are your three essential risks that you're running.
And so do you think that schemes, whether it's a company or the trustees, are better at assessing any of those three risks than others? Are there ones that they always get right and others that they don't?
So there are two that are, I think, to be fair, quite well, there's a well-trodden path to managing them. Truthfully, there's a lot of work that's been done, but I think two that, as I say, there's a lot of work. So I'll take those one by one. So first on the asset side, schemes generally have been what they call de-risking, so coming out of growth assets to kind of manage their volatility, and they've also been hedging their inflation risk and their interest rate risk. So most trustees will think that they're relatively protected when it comes to thinking about the risks they're taking assets. On the covenant side and their exposure to the strength or otherwise of their employer, similarly, that's pretty well developed. Trustees will take advice from covenant provider, who will advise them how to think about the risk that they're running with their employer. And so those two risks pretty well covered. But it's on the liability side, I think, that schemes probably are more exposed than they might be aware of, truthfully, or might not. In the same way as we was talking about an insurance company and the 1 in 200 event, are they thinking in a lot of detail about the risks that they continue to run on the liability side?
Okay, and let's take a deeper dive into that, because liability risks is quite a sort of catch-all phrase. I can imagine there's something else sitting underneath that. I mean, there's obviously the principal risk of, you not being able to pay those liabilities, but what goes into the mix of that? What are the sub-risks you need to consider? So
if you start off with longevity risk, how long people are going to live. Obviously, you'll have some assumptions from your actuary, but as I say, what if those assumptions don't bear out, right? So, we know weight loss drugs, the likelihood is that they will have some impact. And it's early days to know what that's going to look like and over what period. That's an example. So longevity risk, how long members are going to live is obviously a key one. Second is on the benefits. Now, you probably think that you know what they are, but do you really? When you do a buy-in or a buyout transaction, you really do a lot of lifting the lid on what those benefits are. And do you know if there's boxes of paper records, has somebody been through them sufficiently to know if those boxes of papers actually have an impact on what needs to be paid out or not? And it's that kind of exercise schemes would go through when they are actually buying out. So before have you got enough money to pay the pensions that are due under the pension scheme, you need to be really, really clear that you actually know what the pensions are that are due to be paid out, including what's sitting in X number of boxes of paper records, for example.
Okay, so longevity and data, basically.
Yes, exactly. And I think the other one, truthfully, is legislation. And this can come, it doesn't necessarily have to be government driven. So, we saw on the back of the Virgin Media case, that was a case that came to court that had the potential of increasing liabilities. And on the back of that, the government said they will legislate. Well, who knows what cases will come out of the woodwork? I mean, I know most people will think that they're not expecting anything, but I don't think that people were necessarily factoring into the way they were thinking about their liabilities that this one case would come in the way that it did. So I think you have to have the awareness that is a risk that you are continuing to run.
So if we get back to the original question, and you're going to ask your scheme members whether they actually want to run on or not, what do you have to do to manage those 3 liability risks to make it more under control before you even approach your scheme members?
I think you're completely right. I think you do have to. You have to really get to grips with the way that you're thinking about risk. So, as I say, insurance company will think about it, 1 in 200 event. It's worth just asking the question, what scenarios, how are we thinking about that level of risk across all of it? On the longevity side, insurers are thinking about ways to help schemes with managing longevity, and I think we'll see more and more of that. It's always up to schemes to do the work on the data, or that's always a possibility. On the legislation, it's just a known risk that you have to be aware that you're running, and to the extent that it increases liabilities, that's then where obviously you're relying on your covenant from your employer to cover any additional liability that may arise. So if you're sitting there both as a member of a scheme and a current employee, and you're asked that question, to go back to the original headline, do you want your scheme to run on? Do you want your scheme to run on knowing that if things don't go the way that people think they will, and there's a chance of that, who knows what size the chance is, it'll be a scheme by scheme basis, but it could have quite a damaging impact on an employer if things don't go the way that they're expected to go. If that then results in layoffs, for example, not an impossible possibility, not an impossibility, resulting in you losing your job, do you really want the scheme to run on? Or if there's enough money now to buy out benefits, everybody gets what they're expecting, it's fair for everybody, that liability then is no longer a problem for your employer. Doesn't that give you a bit more confidence that your employer is actually only engaged in its own business, and it's not also trying to run an investment fund as well in the background? I mean, that really is the question. I think if it's framed in that way, would it be 50% of people would give the answer they gave?
I mean, I think there's sort of two parts to this if we think about it. I think there's, first of all, your point that schemes are not really considering all the risks in the way that they should. They're very good on assets, they're very good on covenant. Perhaps they're less good on the longevity, and they're less good on the data, the legislation, I guess you could also try and do that. But it seems to me that if you started with the data and the benefits, that would also maybe reveal more about the longevity risks that you are running. So if you started at least to kind of get you a really good handle on the data, and it's almost it's never too early to start, right? Because if you got that data under control and you really dug out all those, blew the dust off the top of those paper records that still exist somewhere in the archives, and really correctly modeled all the benefits, then you would be in a better position, both aspects. First of all, you would know if you wanted to go to buyout, you'd be prepared, right? You'd have less work to do. And if you wanted to run on, you'd also have a much better handle of the risks that you would be running by doing that. I mean, I remember once somebody talking to me about, the nightmare scenario for an uber small company, which maybe had like the CEO thing, when you're taking that on, if the CEO had divorced his wife of his age and then married somebody who's 25 years younger, and then the benefits cover both him and his spouse, that was like suddenly a massive risk on a very, very small company, because this woman was likely to live for like 20 more years than her husband because she was so much younger. I always remember that, always makes me laugh, that example. But kind of like ferreting through, and obviously that is a particularly big risk for a small company because it's one person and the risk is concentrated around the CEO. But it's those kind of hand grenades that you want to diffuse that might be buried in a dusty box somewhere in the archives, right?
Or some, or there was a letter that was written out to a bunch of employees, dear member, we're increasing your benefits from 60th to 40th, right? And it just never quite made it to the desk of the lawyer, and so it never quite made it into the formal records. But all these people are thinking that they've got that promise there. Well, how many people, and is that a reliable promise, and has it just increased the liabilities of the scheme, and if so by how much? So those things are real. They're not I would hate to be the kind of slightly annoying voice of an insurer saying, you've got to buy out because there's all of this kind of fiction driven risk that you are holding. These are these are real risks that kind of we see every day. So I think it's an awareness thing, because what I think nobody in the industry is going to win if these things go badly wrong, because it will reflect badly on all of us, right? So if there is a run-on scenario and for whatever reason it just doesn't go to plan, not an impossibility. There was 5 years down the line, you look back and you say, well, 5 years ago you could have bought out and you didn't. And why didn't you buy out? Oh, you thought, there was some money to be made effectively. Didn't quite work out that way. And now, the employer's struggling and people aren't getting what they thought they were going to get. Was that the right outcome? And, in pensions, we've kind of moved from a scenario where you didn't want to tell anyone that that's what you did when you went to a party, to these things now make front page news. So it could, we can't. I don't think we can afford any more catastrophes that hasten the lack of trust in the pension system. So it's more that, really.
Trust is quite binary. Once you lose it, it's very hard to get back.
Yeah. Absolutely.
I can see it from both sides, and obviously on this podcast I talk to everybody across all of the pensions landscape, but I can see the argument for buyout and I can see the argument for run-on. And I don't think that run-on is for everybody, but I can also I can understand the concern as well that pensions have moved away from what they used to be, in that, they used to be heavily invested in UK equities, they used to be heavily invested in growth, and then we changed the way we valued all of those risks and liabilities, and we became heavily focused on the gilt market. And, to be honest, the government is not in any great hurry for pension schemes to offload all of those gilts either, because who else are they going to find as buyers? So there's all kinds of different moving parts and complexities to all of this, isn't it?
There is, and I think that's why it's the most important thing above everything else is simply that the information is out there, right? So you're absolutely right. For some schemes, run-on will be the right answer, but go into it with eyes open, properly having thought about, the two sides, right? So that for whatever reason, if things don't pan out, there's mitigation in place. It's not unexpected, and truthfully, we've got a responsibility on the insurer side as well to not be opaque about what we're doing. So, and I think if that's the answer to this, and then at least, when decisions are taken, they're taken with the right information in front of people. I think that's all I would ever advocate for, truthfully, because we, as you say, there's benefits depending on the circumstances for both, but the key thing is that you're going into it, fully aware of what might happen.
And I say this as a communications expert, I must admit the thought of trying to explain all of these different risks to a scheme member in some kind of way that's, that's accessible just gives me, that's quite challenging, I think.
Well, you wouldn't, and most of the time, there's no necessity to do it. But what you're seeing in the world of defined contribution is challenges engaging individuals in their own retirement and in saving and so on, and we know that half the reason for that is trust. So I think the most, it's just very important that we as an industry maintain the trust of people who are relying on us for the payment of their retirement income.
Absolutely, I agree with you there. Is there kind of going to go back a little bit maybe to investment? Is there a challenge about what we can do? I mean, I kind of alluded it to before. I think we think that insurers are very constrained, which you are. I mean, from a regulatory perspective, as you've made out, as you've explained, you have to worry about the 1 in 200 year risk. You tend to be funneled into quite a narrow universe of assets in terms of looking very much with a fixed income lens. And does that kind of reduce your ability to kind of invest in growth, aside from the sort of like regulatory challenges? Or flipping it from the other side, do we think if a pension scheme in theory has the benefit of regulatory arbitrage, it can do more? But the reality is that most pension schemes kind of invest like insurance companies, because when they're fought tooth and nail for 2 decades to get to a position of financial strength and surplus, you really want to protect that surplus.
Totally. Yeah,
so how
I
much
completely agree.
budget is there really for growth? Are we being realistic about how much growth we can really invest in from either perspective?
It's a very, you've made a very, very interesting point. I think what we would say as a life company is that we do and can invest in growth and in the UK. And actually, because we have scale, so Phoenix, we have 300 billion under management. Because we have that kind of scale, you can imagine all of the risks and controls and governance that sit around that. That's very different from pension schemes when you think of the size, a lot of them are. So I think we can say we've got scale, and with scale becomes opportunities to invest in growth, truthfully, and then we've got the risk and the governance about what's sitting around that managed in a way that I think people would say that from a pension scheme perspective, they just don't have that kind of the budget, truthfully, or so on, to have that level of control around those kinds of investments. So it's actually an interesting comparison.
Yeah, and also the point is, isn't it, as you made before, is that if you are going to go to run on, you're kind of committing to becoming an asset manager, basically.
You absolutely are. Yeah.
And that is a very, very, very different business to running your ordinary company, whatever that is, unless you happen to be a financial services institution who's already doing that anyway.
You're absolutely right. And it's one thing running money for somebody who would like you to make some money for them, right? That normal kind of asset manager. It's quite something else to ask somebody to run money against a fixed liability. So, it's not like, here's a mandate, do what you can, but here's a mandate, you have to deliver against this liability. Those two things are really quite different, and it's not just a benchmark, it's real numbers that if you don't meet them, there are and potentially quite serious consequences. So you're absolutely right. And to an employer whose business is, I don't know, retail or whatever it is, does that retail business, who they're already worrying about whatever it is that they're worrying about, tariffs or whatever it is from day to day, as the CFO kind of dragged into pension scheme meetings, it feels very, I don't know, it doesn't feel like the right answer to me. But as I say, for some schemes, obviously run on will be absolutely the right thing to do.
Okay. Well, I think that's a great place for us to end the discussion, Claire. I want to say thank you so much for being a guest on the show and for sharing all of your insights and getting us to look at risk through the lens of an insurer. Listeners, make sure you never miss a future episode by hitting the subscribe button. Thank you so much for listening, and thanks for being a guest on the show, Claire.
And thank you. I've enjoyed it. Thank you.